This is chapter video summary number 14. It goes over chapter 25, which talks about the laws of debtor-creditor relations and consumer protection. A creditor is the lender in a transaction, whereas a debtor is the borrower in a transaction. A lien is a claim on a debtor's property that must be satisfied before any creditor can make a claim. There are two types of liens, which include mechanic and artisan. A mechanic lien allows the creditor to place a lien on real property when the latter does not pay for the work done. An artisan lien allows the creditor to recover labor and service expenses. An attachment is a court-ordered judgment allowing a local officer of the court to seize property of a debtor. Garnishment is an order of the court granted to a creditor to seize wages or bank accounts of a debtor. A bankruptcy petition initiates the bankruptcy case. So there's voluntary and involuntary bankruptcy. Voluntary bankruptcy is placed by the debtor, so they claim their debt and own up to what debt they do have. An involuntary bankruptcy is placed by the creditor. So the creditor realizes that there's too much debt, and so they will file for the debtor. Discharge of debts enables the debtor to say that it is no longer responsible for paying certain claims by creditors on unsecured debts. The freedom to contract doctrine is parties who are legally competent are allowed to enter into whatever contracts they wish. The Truth in Lending Act seeks to make creditors disclose all terms of a credit arrangement before they enter into an agreement with a consumer debtor. And then there's the annual percentage rate, which is often referred to as APR, which is the effective annual rate of interest being charged to a consumer by a creditor that depends on the compounding period that creditor is using. Then there's open-end credit, which is credit extended on an account for an indefinite time period so that the debtor can keep charging on an account up to a certain amount while paying the outstanding balance either in full or in payments. Close-ended credit is a credit arrangement in which credit is extended for a specific amount of time and the exact number of payments and the total amount due have been agreed upon between the borrower and the creditor. Lastly, Uniform Consumer Credit Code regulates interest and finance rates, sets out creditors' remedies, and prohibits fine print clauses.